Greetings, Grade 12 learners. My name is Mr. Simbi and welcome to today's accounting lesson. In today's class, we're going to be dealing with the statement of comprehensive income, but my focus is going to be on the year-end adjustments. This is our curriculum scope. However, I will only look at the aspects that are highlighted in green. So you need to look at the other aspects that are not highlighted, as I will not touch them in today's class. By the end of the lesson, I will address how to adjust for accruals in the statement of comprehensive income and the statement of financial position. And I'll adjust for prepayments as well in both statements. And I'll show you how one adjustment can affect both these statements. Here are the key words and language that you need to be aware of. You need to know what is your statement of comprehensive income. You need to know what is your statement of financial position. And remember, the difference between these two is that your statement of comprehensive income is a financial statement that presents the income and expenses of a business. But the statement of financial position, it is a snapshot of a company's financial position at a specific point in time. You will also need to know your accruals and prepayments. I'll expand further on these in today's class. During the exam, there are certain errors that most learners would make, and some of them are not knowing how to integrate these two statements, your statement of comprehensive income and your statement of financial position. But I want to help you so that you do not make these mistakes. Not knowing the correct signs, whether I must add or subtract, are some of the challenges that learners do face. And incorrectly recording accrued expenses, accrued income, prepaid expenses, and income received in advance. These are the exam writing competencies that you need to work on as you prepare for your final exam. Pre-knowledge. What do you know already? So far, from your grade 10 and 11, you know how to draw up the format of the statement of comprehensive income, and you also know how to adjust for accruals and prepayments. In this year, we are going to focus on other adjustments, such as your director's fees, audit fees, when there are accruals as well as prepayments, and how do we integrate these adjustments in both the statement of comprehensive income and the statement of financial position. We're going to go for an ad break, and I'll see you shortly. Welcome back from the ad break. Before the ad break, we spoke about the statement of comprehensive income, and I am going to do certain adjustments with you. To begin with, I'm going to do the prepaid expense. Now, what is a prepaid expense? That is something that you need to know. What is a prepaid expense? Here are some of the content and skills problems that you may face, all right? You need to be able to identify situations that create prepaid expenses, and you should also be able to classify or understand what is a prepaid expense when you go to the statement of financial position. That is, it has to be recorded under your current assets. And then, when you talk about prepaid expenses, these are payments made for goods or services that will be received in the future. All right? So, they are expenses that we have already paid, but the goods or the services will be received in the future. And this is according to the matching principle that expenses are recognized in the period in which they relate, which the related benefits are received, ensuring expenses are matched with revenues they help generate. With me here, I have an extract from Mind the Gap. If you do not have it, it is not a problem. So some of the activities that I'll be doing in this segment are from Mind the Gap. But if you do not have it, as I've said, you do not need to worry because I have all the information that you need with me here. The first one then reads, insurance. You can see we have insurance in the nominal accounts. Already you know this is an expense. Additional information. Prepaid expenses. There is insurance prepaid of 200. What do I do with that then? It simply means I have paid 200 rands in advance for a period that I have not yet used the insurance services. What do I do in the statement of comprehensive income? Remember, opening brackets is very important, and then you bring your amount from the trial balance there. There is your 600. And your prepaid expense amount must then be subtracted. So you come in and say minus 200, and the final amount becomes the 400. But that 200 becomes an amount that we would now take to your statement of financial position. We're talking balance sheet now. Under note 5, trade and other receivables, then we say prepaid expense. All right? So that must be recorded in both your statement of comprehensive income as well as the statement of financial position. The next one is what we call an accrued expense. All right? So far we did prepaid expense. Now the second one is what? Accrued expense. Some of the challenges that you may face when you are dealing with accrued expenses is failure to recognize the accrued expense itself. You must be able to identify situations that create accrued expenses, such as when an expense has not been paid. When an expense is unpaid, that means it is owing. All right. The next step is to be able to classify your accrued expense when you go to the statement of financial position. Where do you record this amount? It must be recorded under your current liabilities. Under your current liabilities. What is this accrued expense? It is an expense that has been incurred but not yet paid or recorded in the accounting period. So we have received the goods or we have received the service, but we have not yet paid for it. So it becomes an accrued expense. Again, we relate with the matching principle. Expenses must be matched with the revenue, that is the income, they help to generate. So in other words, any expense that is incurred in a particular financial period must be recorded, even though it might not yet been paid. It must still be recorded. What we have now is we have water and electricity in the nominal accounts. That is your 7,000. But we are told that water and electricity still due. Others would say owing. All right? Not yet paid is 2,000. What do I do with this amount now? What do I do? All right. So in your water and electricity account, you have to know that this is an expense now. All right. And then you have an amount from the trial balance. And you know that you have an expense that has not yet been paid. And already in your mind, you know that your accrued expense, you still have to pay it. So it is a liability in this case. So that's why when you come here, you have your accrued expenses and you have water and electricity 2,000. When you come to the water and electricity, you now have your 2,000 here. The 9,000 is now your profit and loss. So it means when I come to my statement of comprehensive income now, I will now say water and electricity, the 7,000 from the trial balance, then I add. So the idea is when an expense is accrued, I must add it. When I come here, I add it. And then I end up with my 9,000. And then when I come to the statement of financial position, I'll record this under trade and other payables because it is a liability. I still have to pay for this. There it is, accrued expense 2,000. The next one that I'm going to do is income received in advance. Now, with income received in advance, one of the challenges that you may face is inability to record it as a liability because you're thinking it is income. But don't forget, the moment you receive income in advance, you have not yet given the service or the goods, so it becomes a liability. All right? When cash is received, because the company has an obligation to deliver the goods or the services. Now, you should be able to understand as well that income should only be recognized as revenue in the period when the goods or services are delivered. Okay. And then, here are some of the competency problems that you may find. Recording the amount received in advance as a liability in the statement of financial position. So you have to be able to record it in the statement of financial position as a liability. All right. What is income received in advance? Also known as unearned income or deferred income. It refers to payments a company receives before providing the goods or the service. Here we have an example. We have rent income, 13,000. Then we are told, income received in advance, rent income has been received in advance, and that is 1,000. What do I do? Here's the answer. When you have received income in advance, so here is our rent income account. Remember, it's income, so it will increase on the credit side. On the credit side, it will increase. And then on the debit side, it will decrease. So I have my 13,000. There it is. However, 1,000 has been received in advance. So an amount received in advance, I will now bring it to the debit side. There it is. That's why you see income received in advance, it is also now on the credit side. And then it simply means that is now a liability. And what I take to my profit and loss is the 12,000 over there. So when I come to my statement of comprehensive income, I have my rent income, which is 13,000. Then I subtract the income received in advance, then I remain with 12,000. What do I do with this 1,000 when I get to the statement of financial position? I'll take it to trade and other payables, then I say income received in advance. All right, we're going to go for an ad break, and I'll see you shortly. Welcome back, dear learners, from the ad break. We are now going to do accrued income. With accrued income, you should be able to recognize when income is earned, even though cash has not yet been received. And some of the problems is not being able to understand how to record accrued income when you come to the statement of financial position. What is very important is knowing the signs, what to use. Do you subtract or do you add when you have accrued income? Accrued income, this is income that has been earned but not yet received or recorded by the end of the accounting period. We have interest on fixed deposit in the nominal accounts, and it is 800. And then we are told that interest on fixed deposit is still due and the amount is 400. Remember, interest is not capitalized. What do we then do? When an amount is still due, this is accrued income. An amount is still due, and that amount we must still receive it. When we come to our statement of comprehensive income, the income statement, we'll now say that 800 plus the amount that is still due, the 400. so that we end up with 1,200. All right. So the principle that is very important, very key that you have to remember, that when income is still due or when income is accrued, you must add it when you come to the statement of comprehensive income. And that accrued income must still be receivable. So it goes to trade and other receivables as accrued income over there. Okay, I'm going to repeat again. When we have accrued income in the statement of comprehensive income, we add it. You can see 800 plus the 400, that gives you the 1,200. And in the statement of financial position, that is your balance sheet, you will now say accrued income under your trade and other receivables. The next aspect that I'm going to deal with is bank charges and interest expense. Bank charges and interest expense. Some of the challenges that you may face when you prepare for your exam is the inability to identify the different types of bank charges. All right, so you can see there can be cash deposit fees and there can be service fees. You must be able to add all of those ones and then you record them under bank charges. All right, and remember that bank charges must be recorded separately from interest expense. Bank charges are fees that are charged by a bank for account services. All right, and then we are now going to look at the information that we're given. We have bank charges, which is 6,300. That is in our list of balances. And then we are told that bank charges of 700, interest on overdraft of 200 on a late bank statement to be brought into account. So we have received the bank statement and that bank statement has arrived late and we now have information which we must bring into account. All right? So the first thing is your bank charges of 700. So I'll come now in my statement of comprehensive income, I'll say bank charges 6,300. Then I will add my 700. The next question is, why did I not add the 200? The 200 cannot come here. The 200 will come on interest on overdraft. All right, so I'm going to record interest on overdraft separately. But remember, your bank charges will be under your operating expenses. These will be under your operating expenses. But your interest on overdraft, it will be under your non-operating items. So after you have your operating profit there, then you have your interest income, then interest expense. But it still goes onto your statement of comprehensive income. And then remember that these amounts must still now be adjusted to the statement of financial position. So we will see if we have a positive bank balance, how does these charges affect the positive bank balance? If we have a positive bank balance, there is a favorable bank balance, debit balance on the bank account. We have 15,900. So we will come, then we'll subtract our bank charges of 700 because it's going to take away from our favorable bank balance. Then we also subtract interest on overdraft. We subtract it as well. But if the bank balance is already an overdraft, what do you do then? If the bank balance is already an overdraft, so we're coming here to say 15.9, it's already an overdraft. Remember, I'm giving you an example now. That is, your bank balance can be favorable or unfavorable. If it is unfavorable, it is a bank overdraft. What do? You now say the 15.9, then you add the bank charges because it is going to increase now to your bank overdraft. And then you also add your interest on overdraft. That simply means you now owe more because you have other charges that have been incurred on that same account. So you end up with 16,800. These are the two differences when it is favorable and when it is unfavorable. The next one, I'm going to look at your interest expense. With interest expense, the biggest challenge is the inability to understand loan calculations, all right? And whenever you have challenges, and whenever it is possible to do so, it is wise to prepare a T account. Okay, so what is interest? It is the cost paid by a borrower to a lender for the use of borrowed funds. Okay, and then here we have a loan statement that we've received. And then we have a loan in the list of balances. So the balance on the 1st of March, this is the balance at the beginning, is 55,000. So we'll come here, then we'll say my balance in the loan account. Remember, on the credit side, it increases, but on the debit side, it will decrease. So I'll say my 55,000 there, then the balance at the end, I bring it here as balance BD. Then immediately it becomes balance CD over there. Then I'm told my total repayments are 15,000. That means I'll come now to my debit side where my loan account decreases. Then I bring my bank 15,000. This is total payments. I know that in the total payments, there are two payments. There is the loan and there is the interest. It becomes easy then. I'll say 15 plus 50, that gives me 65. Then here I'm going to have 65. 65 minus 55, then I end up with 10. So the 10,000 becomes my interest on loan. So when I come to my statement of comprehensive income, I am now going to record my 10,000 as my interest on loan over there. After we have made our entry in the statement of comprehensive income, then we come to the statement of financial position. Here, it is much easier to start with the balance on the 28th of February in 2024. That is your 50,000 here. And we know that in the next financial year, we are going to pay the same amount as we have paid. In most cases, the adjustment will tell you that they are fixed monthly payments. So if you come back to the loan account, you remember the 10,000 was interest. That means the 5,000 is for the loan repayment, which you can get if you say 55 subtract 50, then you get the 5,000. That means on the loan, we're paying only 5,000. So if we're making fixed monthly repayments or fixed annual repayments, it means in the next financial year, we are going to make a payment again of 5,000. So you come here, then you say minus 5,000. You now remain with 45. That 5,000 therefore comes and becomes your short-term loan, which is 5,000 over there. And then I'll look at my bad debts. The biggest challenge is confusing between the provision for bad debts and bad debts, all right? And then remember that your bad debts must be recorded in both the statement of comprehensive income and the statement of financial position. Okay, so bad debts refer to accounts receivable that a company does not expect to collect at all. The information that we're provided with from the balances and totals, we are given debtors control of 16,100 and we have bad debts of 1,000. The additional information then reads, J. Jones' debt will be written off as a bad debt, 200. What do we do with such information? When you come to your statement of comprehensive income, you take your bad debts, which is in your nominal accounts, your 1,000. And then you now say, J. Jones' debt, which is now being written off, 200, you add it, then you end up with 1,200. But that 200 must still be adjusted in the statement of financial position. Very important. So you come here, you say your debtors control, which is 16,100. You remember this one now. Then you subtract the 200 of the bad debt, and you end up with 15,900. My first activity is going to come from the NSC November for the year 2023. My focus is on paper 1, question 1. I'm going to take certain adjustments that we're going to do together. Let's begin. Adjustment number 1 reads, commission income of 41,000 is owed to the business. So the key word here is owed. That means there is income which is accrued. You know that once income is accrued, you must add it. You add it once income is accrued. So it means I'm going to come now on my statement of comprehensive income. Then remember, under my other income, so it is under my other income, I'm going to now have my commission income. So I'm just going to say, all right, commission income. Then I'm going to take the amount from the list of balances, which is my 277,000. And then I know that when an amount is owed, I add. So I'm coming here to say plus how much? 41,000. Are we together? Okay. And then we should be able to record this amount as well in the statement of financial position. Do you know where we're going to record this? All right. In the statement of financial position, we go to our trade and other receivables. All right. Trade and other receivables. What do we say? We're going to record it as accrued income. All right. Accrued income. Then we're going to have our 41,000. That is how we would record this particular adjustment. Let's go on to the next one and see what we are required to do. The next one reads, fee income includes 47,150 for February and March. Very interesting, this one. All right. Note, fee income increased by 5% on 1 March. So here it increased on the 1st of March. All right. That means in February, there was no increase. But we received an amount, which is 47,150. We understand that this is for 2 months. So can I take this amount and divide it by 2? Certainly not. Why? Because March has increased by 5%. All right. So what I know is that in February, it had not increased. So it was 100%. Are you following? Let's go to March. In March, it then increased by 5%, making it 105. You still with me? That means the total that we received for these 2 months is 205, which is equal to the 47,150. What do I want? I know that I must receive fee income until February. However, we've received it now until March. So March is income received in advance. So we want the 105. But the total we have is 205. Then we multiply this by 47,150. We should be able to punch this on our calculator. And then we now say, we want 105. And what do we have? We have 205. And then we multiply this now by 47,150. How much do we get? We get 24,150. So I'll come here, then I'll get my 24,150. So I must record this now in my statement of comprehensive income, fee income. So I'm coming to my other income, all right? So I'll say fee income. I open my bracket. How much is in the list of balances? 303,000. What is the situation here? We have received for March. March means we have received income in advance. So we subtract, all right? Very important that you understand the keywords, underline the keywords. Here, they're telling us that the amount includes February and March. We know that the year must end in February. So already we know that March is received in advance. And the amount is 24,150. So I'll come here, then I'll say minus 24,150. And then I close my bracket. And then how much do I end up with? On your calculators, quickly, you end up with 278,850. 278,850, like that. 278,850. And then, do I record in the statement of financial position? Yes. So I'll come here to my trade and other payables because I have income received in advance. Trade and other payables. Then I'll say income received in advance. How much was that? 24,150. That is what I would then do. Let's quickly go on to the next adjustment. The next adjustment reads, Butle rents 150 square meters of space. So this now relates to rent. This relates to rent, okay? So we are told that she rents 150 square meters of space from Prime Storage at a monthly amount of $330 per square meter. Remember, underline the keywords, $330 per square meter from 1 May. Very important. The company then increased the space by 25 square meters on the 1st of November. Very important as well. Rent was paid until the 30th of April. So here we want to calculate our rent. Okay. Now, this is rent expense, remember. And rent was paid until April. Remember, the financial year has to end when? In February. We can calculate this very, very simple. Please follow this. We know that our rent, at the beginning, had 150 square meters. Okay? This is from the 1st of May. From the 1st of May, we have 150 square meters. And we will only increase on the 1st of November. So from the 1st of May, so we're going to say May, June, July, August, September, October. Do we count November? No, because the 1st of November it increases. So for how many months was that? Until the 30th of October. That gives us 6 months, all right? So we had this space for 6 months. And we know that we are paying how much per square meter? We are paying $330 per square meter. We're paying $330 per square meter. We are going to punch this now in the calculator. All right? So let's quickly do it together. We are now going to say we have 150. All right? Then we say multiply that by your 6 months. All right? And then you still multiply it by your 330. Someone would have started to multiply by 330 before the 6 months. And then you get 297,000. So for the first 6 months, the rent will be 297,000. So come here, it's 297,000 for the first 6 months. And then it increased on the 1st of November until 28 February. That is what we want for the statement of comprehensive income. All right? So if we count the months, it will be November, December, January, February. So we're sitting with 4 months here. And then we'll now say the space has increased now. It is 150 plus 25. That gives you 175. 175, then we say this is being paid a 330, if you want to start with the 330. And then now you say this is for 4 months. Let's quickly look at it again. So I'm now saying I have my 175, and then I say multiply this by the 330. That is what we're paying per square meter. Then I now say this was for the 4 months. That means I get 231,000. That is what I get for these 4 months. 231,000. When I come to my statement of comprehensive income under my operating expenses, I will now say rent expense. And my rent expense, I now know that I have two amounts that I'm going to add. It is my 297,000 plus my 231,000. That is going to give me the total amount, which is 528,000. There were several other ways in which you could have done this adjustment, but I thought let's do it in a very simple way. So we count our amounts, then we know how much we are supposed to get. And then we know that we have received, we have paid in advance. We have paid in advance for how many months? For 2 months. So that one becomes easy. If you want to get the one for the 2 months, you might just divide this by 2, all right? And then you end up with 115,500. That is for the month of March and April, because we paid until April. So we then go to my statement of financial position. Remember, under my current assets, I now have my prepaid expense. I now have my prepaid expense, which is your 115,500. Delenus, let's go for an ad break, and I'll see you shortly. Welcome back from the ad break. We are now going to look at the NSC June for the year 2023 paper. Again, paper 1, and my focus is on question 1. And we have an adjustment which reads, the auditors are owed a further 38,800 for the current financial year. So here are the key words, a further, okay? So that simply means this is an accrued expense. It therefore means I'll come here to my statement of comprehensive income under my operating expenses, and then I'm going to have my audit fees, and I'll open my bracket. I have my 155,200, and then I know that we have an accrued expense which is 38.8. 38.8. So I can close my bracket now, and then I end up with 194,000. 194,000. I know that this amount must be recorded in the statement of financial position. Where will I take it? Definitely trade and other payables. And then what do I say? This is an accrued expense. Open bracket, I have my 38,800. Okay, let's look at the next adjustment then. The next one reads, received 9,000 from the insolvent estate of a debtor, Billy Kroon. His estate paid 80 cents, okay? Very, very important that you prioritize information. Whatever you are given that you see is very important, you underline it. So it means the 9,000 that we received is the 80 cents in the rand. And then we have to write off the outstanding amount. So we understand that we received 9,000 here, which is 80 cents in the rand. Okay, so the amount that we are going to write off now is the 20 cents, such that the entire debt becomes 100 cents. So this is what we want. So we can simply say, what I want is the 20. What I have is the 80 multiplied by the 9,000. How much do I get? I'll come here and I'll now say, what I want is the 20, but what I have is the 80. Then I multiply all of this by 9,000. It will then give me 2,250. 2,250. So I'll come here, 2,250. So I'll come here now, under my operating expenses, and then I'll say bad debts. And then I have 16,200. But I now have an amount to record further as bad debts, 2,250, because the balance, which is the 20 cents, must be written off. So we have written off in this case. But once I have done this, I have to keep at the back of my mind that I am also preparing the statement of financial position. So I'll come to my trade and other receivables, all right? And I'll come to my debtors control. Remember, this is current assets now, current assets. So I'll bring my debtors control amount, which is 645,230. So I'm bringing it here, 645,250. Then I'll now say minus. When a debtor pays, that amount will be subtracted. So I'll come and say minus the 9,000 that was paid. And the amount for bad debts will also be subtracted, minus 2,250. Someone would have just subtracted the entire amount. Remember here, it's going to be 2,250. So someone would have just subtracted the 1,150 at once. That would still be correct down here. Okay, let's quickly go on to the next adjustment. It says, the provision for bad debts must be increased to 25,720. Very, very key here. And once you read this information, underline the key words, increased to. Okay? So when I'm preparing my statement of comprehensive income, I know that in the statement of comprehensive income, I record either an increase in provision, which is an expense, and a decrease in provision, which is income. In this case, I have 25 as compared to 21. You can see it is an increase. So an increase is an expense, so I'm going to go to my operating expenses. Then I'm going to say provision for bad debts adjustment. Okay? Provision for bad debts adjustment. I open my bracket and I'm now saying it is my 25,720 minus my 21,020. The difference is what I record in the statement of comprehensive income. And the amount that I have is 4,700. That is what I record in here. But when I come to the statement of financial position, remember, I've already done some adjustments on bad debts. I want to see if you still remember what we did under our current assets. We had those calculations where we had debtors control. You still remember? And we said 645,250. And then we said what? Minus 9,000. You still remember now? And then we also said minus 2,250. So we will now come and then we'll say minus. We'll minus which one? We will not minus the 4.7 because here we take the entire amount that has been adjusted to. Not the 4.7, but we'll take the entire amount, which is your 25,720. That is what comes to the statement of financial position. So you must be able to differentiate. In the statement of comprehensive income, we look at the increase or the decrease. But in the statement of financial position, we look at the amount that it has been increased to. So we take the 25,720. Dear learners, we're going to go for an ad break, and I'll see you shortly. Welcome back, dear learners. Before the ad break, we did interesting calculations, and now this is the curriculum scope recap of the things that we have done. I've looked at prepaid expenses, accrued expenses, income received in advance, and I've also looked at accrued income. I looked at bank charges and interest expense. We have also done bad debts. We have covered provision for bad debts adjustment. You will need to look at calculations that pertain to depreciation, the profit or loss on sale of an asset, as well as your trading stock deficit or surplus. Here are the keywords and language. The statement of comprehensive income, that is a financial statement that represents the income and expenses of a business. And then the statement of financial position, which is a financial statement that provides a snapshot of a company's financial position at a specific point in time. Then remember what are accruals and prepayments. Here are your exam writing competences. These are some of the common errors that you need to take heed of. Not knowing how to integrate the statement of comprehensive income to the statement of financial position, and not knowing the correct signs, whether you should add or subtract, and incorrectly recording accrued expenses, accrued income, prepaid expenses, and income received in advance. For further exam questions, you may look at the June 2021 NSC paper, question 2, the November 2020 NSC paper, question 1, and the NSC May-June 2019, question 4, as well as the NSC November 2018, question 3. We have come to the end of today's lesson, and I hope to see you soon. Goodbye.